This is basically lecture number 15 of our class. Now we are talking about the working capital. Guys, I want to tell you that the working capital basically means the amount of net current assets. What is mean by the net current asset? What is mean by the net current assets? Basically, net current assets means current assets minus current liabilities. Current assets minus current liabilities. We have discussed in the basis of accounting what are current assets and what are current liabilities, but I make you remind about the current assets and liabilities. Current assets are those assets having useful life of less than 1 year. Means anything we have put in our showroom, that is inventory, to sell it out to the customer. This is inventory, and this is current assets, including current asset. And like anything that is to be received within the 1 year, receivables. In inventory we note it about debtors. These are current assets. And cash that we use for daily life and the bank that we use for daily purposes, these are current assets. And if we talk about the current liabilities, then current liabilities include current liabilities. Current liabilities includes all those liabilities that are to be paid within 1 year. All those liabilities to be paid in 1 year. What does you mean about that? For example, we have purchased any good on the credit. We have to pay in 60 days the amount of cash, in 60 days, in 70 days, in 90 days. Then if we are creditor or payable, then it will be the current liability. Or any other thing can be included in current liability. That includes the bank overdraft, you can also include short-term loans in current liability. Basically, I am talking about the difference of current assets and current liabilities basically relate to the working capital. This is basically the working capital. Working capital basically means the net assets. Working capital basically means the net assets. What does it net assets means? Net assets actually means the when we remove all the current liabilities, basically it moves when we remove all the current liabilities from the assets, the remaining amount become net assets. This removing the current liabilities from the current assets, removing the current liabilities from the current assets, the remaining will become working capital. Do you understand? In companies and finance, working capital can also be defined as the amount of finance, finance required to meet day-to-day operations. What does it mean? That it means that what will be the amount of finance required to run the company, to run the basic needs of a company. For example, if we are a showroom, or if we are a store like that sells the goods, that includes inventory. Simply I am saying, if we have an inventory in our store that we use for selling, and then we earn our profit and then margins. For example, it includes $50,000. $50,000, and the trade receivables here are about $40,000. And the next thing, short-term loan are about short-term loans are about $30,000. Then if you are asked to calculate the working capital, how will calculate? If you will ask in question to calculate working capital, calculate working capital, then what will you do? You need simply the formula current assets minus current liability. All you know about current assets, there are two current assets, that is inventory and trade receivables. Here you can see inventory and trade receivables. Here inventory and trade receivables are your current assets. Inventory and trade receivables are your current assets. Inventory and trade receivables are your current assets. I am repeating again. Inventory and trade receivables are your current assets, and a short-term loan that are 30,000 are your liability. Short-term loan of 30,000 are your liability. Then what you need to do? Current assets minus current liability. Simple is that. Current assets 50,000 plus 40,000 minus current liabilities that include short-term loans. What we have? 50,000 plus 40,000, we have 90,000, and 90,000 minus 30,000, we have 60,000 as a working capital. This is basically what you need to understand. So what is working capital? How it will be calculated in paper? I can also tell you that if in the above example, if we include one more thing that come in my mind suddenly about trade payables of about $15,000. What will above example look like? It will simply look like that. Current assets minus current liabilities. Current assets, rewrite again. 50,000 we have 40,000. It is about 90,000. These are current assets. In case of current liabilities, we have short-term loan and creditors. Short-term loan, what was the amount of short-term loan? We have seen the above question. Short-term loan was 30,000 and payables 15,000. Current liabilities, short-term loan about 30,000, and payables are about 15,000. Add both, it will become ultimately 45,000. These are current liabilities. And then what we have? Working capital, which means simply current assets minus current liabilities. You need nothing. Everything is so simple. 90,000 minus 45,000. The resultant 45,000 is basically the working capital. Do you understand, guys? Everything is so simple and clean and clear. You only need to understand about the formula of the working capital, how the working capital works, what are current assets, what are current liabilities. Your main theme, your main focus should be on the current assets and current liabilities. If you are able to identify which are current assets, what are current liabilities, you will find no problem in calculating the about the working capital. After that, we are talking about the profitability ratios. Profitability ratios. Profitability ratios means the how the capital is employed in our company and how our company is earning profit, how much capital is employed in our company, and by using these working capital, our company is able to manage, our company is able to run the profit, our company is able to justify the profit. For this we have return on capital employed. This is basically, you can write return on capital employed like this. Profit before tax and capital employed. Now Jasmine and Ahmed will ask, what is profit before tax, which we have studied in the previous class. In the profit and loss account, before deducting the tax, we have an amount of profit which includes profit, that is called profit before tax. Okay, understand? Or simple, I can say profit before tax. If anyone was absent in the previous class, I can tell you by this method. Look at this. This is basically profit before interest and tax. And then how it is calculated. Basically, we have a figure of sale in our question. Then we subtract it from the cost of sale account. And the remaining one will be the gross profit. And when from the gross profit we subtract admin and selling expenses, and when from the gross profit we remove admin expenses and all the selling expenses, the remaining thing is profit before tax. We have studied in the previous class in detail, but now some students are asking me again to explain this. That's why I have told. If you want detail, you can see me the recordings of previous class. Okay. What are you telling about, Ahmed? Okay, right. I can give example. Okay. Keep this in mind. Okay. I understand. Okay. What is basically now I want to tell you what is basically capital employed. Capital employed means how much amount of capital was employed during the working of the company. If I will explain, net non-current assets, what is my marker doing? What is my stylus doing? non-current assets minus current as minus working capital. Now you will ask, what about, sir? We are not able to understand. I am here to make you understand this concept. I am saying non-current assets minus working capital. Now you guys know well about working capital. I need not to explain again. Not current assets means working capital means current assets minus current liabilities, which we have solved in the previous example. So this is about the working capital employed. Understood. Now I want to tell you about a trick that is used here, can be used everywhere.